It's gone past. Good morning, ladies and gentlemen. Welcome to the Local Pension Committee's meeting. I'll start with the agenda. You will have had the minutes of the meeting held on the 11th of September. Question time.
Oh, sorry, Mr. Chairman. Under minutes, I've just discussed with Kat, page 11, future meetings. We've got down the 5th of June. It should actually be the 4th of June. 5th of June.
Right. Okay. Kat, how do I, on this, on the keyboard, how do I increase the volume for hearing?
On the top of your Surface Pro, not the power off button, but there should be a little toggle where you can, on the right hand side, increase the volume.
Which one is it at the top? I think... I'm not sure whether that's worked.
It has. It's gone down. It's gone quiet now.
I can hardly hear now. Which one is it, Kat?
So the button on the top, there's a button for decreasing and increasing. So on the right hand side, not the most right hand button, but the right hand side of a longer button, you should be able to press that and it will increase your volume.
It just says page up, page down, home.
Up right on the top of your Surface.
Yeah, I'm going on the top of the... Oh, it's going down. I want it to go up, don't I?
Yeah, so if you press the opposite side of that.
Whatever I do, it seems to be going... Oh. All right, now I've got it. Okay, sorry about that. I can hear you all now. I thought I was having to go for a death aid. Right, questions asked by members under standing orders. There aren't any as far as I understand it. To advise of any other items for which the chairman has decided to take as urgent, the answer is there aren't any other items of urgency. So could I ask if anybody's got declarations of interest in respect of items on the agenda?
No, Chair.
Okay. Then we'll go into the substance of the meeting. I think, Bullish, you'll introduce it. It's the governance review. It's on pages 17 to 32.
Chair, can I just request any presenter, can we go slowly by the page because technology does take time to come to us as well.
Okay.
Is everybody ready?
Yep.
Yeah, okay. We're ready now. Yep.
Okay. We've got Claire Scott, who is the fund's independent advisor, who we commissioned to do a report into the governance of the fund. This paper has been taken to the board. It's been updated since for comments from the board. We've got a number of improvements or suggestions that the fund is considering, and we've got a table within the report, page 18, which shows the recommendations. There's a number we've highlighted as high priority and a fund response next to it. I don't want to go through each one individually. I think Claire is available and ready to take us through the paper and her findings. Claire, are you available?
Hello, hi, thank you, and hello everyone. Nice to see you, albeit virtually. I do have a set of slides which I'm planning to share my screen now, so I'll work on the slides rather than going through the specific pages of the report. So just bear with me while okay, you should be able to see my slides now. Okay, let's just do this. Just to start off with, I think in terms of a governance review, I think when we think about governance, the way I like to think about structures is that a structure with weaknesses can work perfectly well if people are acting with integrity, and although we've highlighted some areas for improvement in the Leicester governance structure. There's absolutely no criticism of anything going particularly wrong at the moment. So that's first thing to say. I think a tighter and strong governance structure, I think, helps to protect potentially when things go wrong in the future. So that's how I'm thinking about putting the fund in a better position and sustainable for the future. And as Bulesh said, we spoke to the pension board in October about the review, and they saw these slides as well. And with their role in terms of assisting the fund, their role is mainly focused on investment and pensions administration and governance. So it's particularly relevant for them too. So without further ado, I'm just going to highlight the kind of broad areas that the report looked at. I'm not going to cover each of the recommendations in detail. I'm happy to answer questions just in the interest of time. You've got a very full agenda today. First of all, just a reminder of the various bodies involved in the governance of the local government scheme and the Leicestershire Pension Fund, various bodies nationally and locally. And the first area that we looked at was just the overall governance structure within the Leicester Fund. And I think encompassing all the recommendations in this area was really around the clarity of responsibility in terms of the committee and the pension board as examples. So the committee and the council are responsible for all aspects of the fund, and there were a couple of inconsistencies in some of the things that we looked at, and it's to clarify that the local pension board is there to assist the authority and the committee in its duties, but the only real decision making that the local pension board has is actually whether or not it should report any breaches to the pensions regulator. So all the recommendations, and we've got the terms of reference on the agenda as well, that sort of helps to clarify and just expand the terms of reference, which were particularly were quite out of date. There's also a recommendation around the local pension board producing an annual report, and that should help to improve communication between the committee and the board. And also, I suggested a standing item, or a standing invitation, should I say, of the chair of the local pension board to attend the local pensions committee, and vice versa. The chair of the local pensions committee can attend the pensions board, and purely as an observer. It's not intended to be an active part, but it's really to observe how the governance is working. So I'll move on to the next area. The area of investments is an area which I'm suggesting that we look at in a bit more detail, and officers have suggested we pick this up through the strategy review in January. The fund has quite complex investment arrangements, a large number of investment managers, particularly given that the size of the fund. And I think we need to make sure that we're looking forward in some of the investment work. You see a lot of investment performance and backward-looking investment, but I think sometimes it's better to think about what are the issues going forward. Are the funds going to perform moving forward? And I think that some of the refocusing of some of the reporting might be helpful, and particularly thinking about the impact of pooling on the investment governance, I think will be helpful. The investment committee does part of this role, but it does tend to meet only when this particular decision are needed in terms of changes, and that could be an option for moving forward in terms of governance. So I'll come back to the governance of the committee agendas later on. So we'll hopefully pick that up in January. That's what the officers are suggesting. We'll review that. There's a general review of the good governance review by the Scheme Advisory Board. We've had an eye on that for a while. I think you've seen the good governance review report so far. I understand that the Scheme Advisory Board's review will conclude early next year, and then the recommendations will be handed over to government to then implement. So we don't really know how long that's going to be, how long the government will take after that. But essentially, the Good Governance Review is thinking about governance in the context of how the scheme is governed within a council, and a lot of the issues and guidance around nationally in the legislation is really out of date. So that's going to be put right, we hope. And in the context of the council's governance, the two particular areas to highlight here are the appointment of an LGPS senior officer, so who individually is accountable for the governance of the pension fund, and does not necessarily need to be the same person or the Section 151 officer of the council. And within that, there's the issue of conflicts of interest, which is my next slide. An area which the conflicts of interest within the pension fund at the moment really rely on the conflicts management adopted by the council, and at some point I think the Scheme Advisory Board review will require you to have a fund specific for the pension fund in terms of a conflicts policy, and I've given some ideas on how you might think about just tailoring the policy and thinking about how some practicalities of trying to manage the conflicts, particularly to the pension fund, and perhaps, for example, some regular training on examples of conflicts of interest to stimulate debate and thought on what the issues might be. The next area, as part of the Good Governance Review, there will be some consideration of knowledge and training for pension committees and pension boards. The board at the moment has a legal requirement under the Pensions Regulator Code, and I suspect that those regulatory requirements for training will be applied to committee as well. The fund does have a training policy that was put in place maybe about 18 months ago, something like that, or maybe 2 years ago. And some suggestions for just tightening up and implementing some improvements then, particularly around training plans. The regulator does talk about planning training based on the assessment of knowledge of the committee and board and individuals. And just as a reminder, I understand CAT has issued via email a form for each member of the committee to complete on their knowledge assessment. So I was asked to give a reminder for you all to do that. So please return that back, please. Thank you. I think one area I've suggested thinking about is in terms of setting a standard for training. Is there should all members, as a basic, for example, have a certain minimum number of hours, or is everyone required to complete the Pensions Regulator Toolkit, for example? So thinking about those to improve sort of overall standards in decision making. And finally, just picking up on some other operational issues. I have picked up, there are a number of day-to-day issues which I've raised with officers and not directly in the report. But one of the areas around agenda planning, given that the remit of the committee is broad, it covers all pension fund matters, and linking the terms of reference, which you'll consider in the next agenda item. A suggestion would be to have a plan around the agenda to make sure that all the items in the terms of reference are covered within the agenda at some point during the year or every 2 years or whatever the necessary frequency might be. I'm conscious this might add to the committee's agendas and workload. So I think that ties in nicely with looking at the investment governance as well and making sure we make the most of the time of committee. So that's all my slides today. I'm happy to take any questions on any of the recommendations in the paper. Apologies, I knew want to do a quick overview to allow more time for questions. Peter, I think you're on mute.
Right. Okay. Thank you very much, Claire. Has anybody got questions for Claire on that report? No? Okay, well, thank you very much indeed then. Thanks, Claire, for that report. Certainly, the agenda setting item and the items on it do need to be thought about and perhaps incorporated when we come to it. So we'll move on to the terms of reference, and I think Kat, you introduced that.
Yes, so on the revised terms of reference, I wasn't going to speak too much to it, as it's not a fundamental change to how the pension committee will actually work. We've consulted following the relevant legislation as well as Claire's governance review, and the main change is it just clarifies that the role and the role of the committee is a board and makes explicit reference to LGPS Central and responsible investments. It just felt relevant to do that, especially considering we reviewed the board's terms of reference and made those a lot more detailed. And then also to put that the role of the board within the committee's terms of reference, in that the committee would have regard to any comments put forward by the board in its role as a basically a scrutinising body. I wasn't really going to say anything more than that unless anyone has any questions or comments.
Right. Any members? I'm just looking to see if anybody's got a question, but I don't think so, Kat. Because these terms of reference shall be reviewed on each material change to those parts of the regulations covering local pension committees, and at least every 3 years. Okay, if that's acceptable to everybody.
Yep. Yes, Chair.
Okay,
yes,
then
Chair.
we'll move on then to the annual report and accounts, and welcome Declan to introduce that, please.
Thank you, Chair. Just find my bit of paper. So the annual report just before the annual
We're breaking up, Chair.
Yeah, I know. Kat, is there any reason why Declan's breaking up?
Declan, it almost looks like you're on mute, although I can kind of hear partial.
committee see just for that kind of chance. Oh, sorry.
You're breaking up quite a lot, Declan.
Okay. Well, things have come back a bit now. The audit report has been not included previously, but it feels useful to include it just for sort of transparency for the committee to see what's going. And in terms of the processes of the county council, the corporate governance committee is responsible for kind of the oversight of the. Mr. Bedford, can you hear me now, or is it still?
It's a lot better than before, Declan.
Oh, it's come back up. So the corporate governance committee does look at the audit and the external auditor does report into them. Basically, kind of that's where the assurance about has the county council done the right things in terms of putting together. So they see things like the internal audit. So it really is that kind of additional layer of visibility just for the committee. And the report is a joint LCC pension fund report, so there is more in there than kind of there needs to be to a great extent. But that just kind of it just reflects the way that the audit is done. Sorry, I lost my thread. The actual outcome of the pension fund was an unqualified opinion, which is positive. The main point that the auditor made was around the difficult to value pension property assets. Now, this is going to be in common with with most pension funds, and because the market pretty much died after the kind of the COVID kind of crisis sort of first hit, transactions aren't taking place. You cannot value assets. Like I say, that's just in common with other funds. The other element you've got in there is that you will notice in the report there was a red item around the IT audit work that the auditors did. Now, the impact on the pension fund is fairly immaterial. It's mainly an LCC issue that's been highlighted there. So in terms of turning to the main sort of the annual report, I won't go through it all. There's quite a lot in there, and most of it, to be honest, is just sort of factual kind of statements, just there for completeness as it goes to the AGM, and a lot of it as well. Bear in mind, this report stops at the end of March, so it's got quite old, and ideally we'd have done the report sooner, but it's the delay of the audit is what's kind of pushed it back. So I'm going to pick out sort of some of maybe the more interesting sort of bits of the report. If you go to page 52, you'll see the kind of it just pulls together some of the cost information there, and you'll see it's kind of alarming at first that the costs have gone up from 36 to 40 million. And there's the reasons are sort of broadly positive. One is the fact that as the asset base of the fund goes, so we've got more investment through that sort of growth. You do pay more to the fund manager because it tends to be on a percentage basis. And the other item hitting there is transitional costs with Central. So as we moved to the emerging markets funds, I think that the payback was something like sort of 5 years. So although the drop off in fees is really sort of good overall, it does cost you a few £1 every time you want to kind of move assets around, because you're sort of paying to buy and sell them. So over time, that percentage that I just touched on will drop away as we sort of transition more to Central, but in the short term, it just causes a bit of a blip. You'll see halfway down that page, it talks about cash flow as well. That's quite an important one. Cash flow being positive is useful for the fund because it means we can commit to the more illiquid sort of investments, which does tend to come with a little bit of a sort of a beneficial return. And it does give us flexibility when we're transitioning to places like Central. You're not necessarily, cash just kind of oils the wheels, as it were, of those transitions. So that's beneficial. 53 kind of illustrates that quite well. You'll see it's mainly driven by the employer contributions is the big income for the fund at the moment, which outstrips the pension. And those employer contributions will keep going up as the fund tries to close its deficit for the next few years at least. Moving into page 54, we don't tend to look at this too much at committee. It tends to be more the remit of the board, looking at the administration. But this starts looking at the number of pensions. You'll see we're up to about 95,000 here. It's the biggest transactional process Leicestershire County Council does, far bigger than anything else. And it's tucked away a little bit. And in a couple of years' time, it's looking like there'll be over 100,000 members of the fund. The chart there is quite interesting. I don't think it's a surprise to anybody that the number of pensioners is going up, but you can see the number of contributors as a start to pick up again, and it kind of reflects the big employees in the fund are the local authorities, and although the pain of austerity is still there, the level of cuts by government have reduced and been replaced by kind of demand pressures. Demand pressures come with staff. You can see why that's driving up. And also there's a whole range of other employees in there. Areas like academies have been taking on a lot of extra support staff, which is LGPS. So you get that kind of interesting uptick. Go down a bit to the 56 again. Like I say, this information goes to the board on a quarterly basis, but you'll see there's the admin performance. If you look at just the raw percentages, they're pretty good. Everything exceeding 90%. They did miss a handful of targets, and it was a big year last year for the administration section. You'll remember on the risk register we had the system upgrade, and there's been a few bits of legislation sort of being introduced and sort of being worked through as well. So it just puts pressure on the same team. So overall, it's a good performance, but one that the board do keep a close eye on. Next probably area of interest is probably around sort of page 16. The committee obviously sort of see this information, but it's useful just having it kind of laid out quite simple numbers. But you see that second table, the performance was pretty disappointing. But if you remember back to March, that's where the COVID crash had just happened. We hadn't had the full bounce back yet. So those numbers have kind of improved over the course of this year. But you will notice as well that we're behind benchmark, and that's kind of the way the fund is tilted. We've got a lot of UK assets which are still performing quite poorly relatively to sort of global, and we're also kind of this value bias. Sort of your more established kind of companies rather than sort of the more growth sort of type companies of the technology stocks. And again, it's been well covered in the sort of the financial press about the technology stocks didn't get hit as hard at that time. That has started to sort of unwind recently, but it's taken a little bit of time, and the technology overall has outperformed, which has left the fund a little bit behind. Moving through the bits, we've added a bit more than last year, sort of from 63 onwards in terms of responsible investment, just because that's obviously a key area of interest and growing importance in the fund's activity. There's not a huge amount in terms of the completion bits. That's partly because we only put our first RI plan in place in January, so sort of 3 months period. It's had a chance to be reported back on, but the plan's in there, and you'll see on the agenda today there's several more items that have been picked up in there. 66 or page 66 also covers off the pooling, and actually 65 it starts on, and you see the progress has been pretty slow still on pooling. Only about 10% of the fund had been pooled at sort of the end of the year, which is kind of a couple of years in. We do have another third of the fund approximately sort of with sort of advisory agreements with Central, so they're helping it, but we're only gaining we were only gaining from, like I say, about 10% in terms of those manager fee reductions. Now there's a lot in progress at the moment, and you'll see later on in the agenda, the update from the subcommittee sort of outlines a couple of big ones, but it is taking quite a bit of time to be pooling, probably longer than anybody thought. It's that difficult getting alignment with 7 different partners, 8 different partners actually. So that's it. I won't go into too much detail on the rest of pooling. If you go down another key bit on the report, again, I won't go into it too much. The governance compliance statement 73. Now, Claire's obviously come along and talked about governance. We've got some things like the Good Governance Project led nationally by sort of scheme advisory bodies. There's a lot of focus in this area. So this is an area that is important and will continue to kind of grow and develop over the next few years. As it's just that it's a key financial asset in people's lives. So it is always going to be a heavily regulated area. So again, most areas there are fully compliant, and if they're not, it's kind of a handful of things that we need to improve. But the work sort of Claire's done will sort of pick up in terms of that, making sure we do cover those improvements off, so we can kind of keep on top of things. They were all the bits I was going to go through in the report and the accounts. Like I say, it's really just sort of an overview for committee to give you an idea, that sort of summary of the year, and give you a bit of an insight into what's happening on the administration side as well. So happy to take any questions or comments.
Right. Has anybody got questions to Declan on those accounts? No, I can't see any. Oh, yes. I think it's Peter Bedford. Yeah, Peter.
Hi, can you hear me, Chair?
David, rather.
Can you hear me, Chair?
Yeah. Mr. Bedford.
You're a little bit faint.
Okay, can you hear me now?
Yep. Yeah.
Okay, just to say thanks Declan for that update, and also I know how much work goes into audit, so thanking everyone that was involved in the audit. Just a quick question around the point on page 74-75 around compliance and best practice. Do we get any kind of additional feedback from auditors around best practice? I know we've got we're fully compliant with a lot of these, all the areas, but do we get any additional kind of feedback from them that says, okay, you're fully compliant, but we've seen in other organisations this is best practice? Do we get any additional stuff on that?
Not from the external auditors at the moment. Their focus is purely on the statement of accounts. So they do a bit on the sort of LCC side of things around value for money, but they don't do that on the pension fund. And it definitely is a gap. The good governance report that sort of got held up a little bit, one of the recommendations that likely to come out of that is that every 2 years you do get an independent external review of governance, and to pick up that sort of thing, just kind of go through, how does the sort of scheme operate and what suggestions there could be. And obviously those kind of, whether it be an auditor, an actuary, or even just a sort of independent consultant, they'll see a whole range of schemes. So hopefully they'll be able to do what you've described, with just picking that up. But yeah, that's something that's going to come in over the next year or so.
Thank you.
Okay, thanks. Ian, you've got a question? No.
I think it's Claire, Chair.
Yeah. Okay. Claire,
Thank-
sorry.
That's okay. Thank you, Chair. Declan, I just wanted to ask you. You mentioned that one of the risks highlighted by the audit areas highlighted by the auditor's plan was, I think it's in the area of IT. But you said it didn't apply to the fund, or applied less to the fund. I wonder if you could comment on to what extent that is a risk to the fund, and if it isn't a risk to the fund, have the pension systems had a similar audit that refers to?
So it's not relating to the pension system. It's the sort of the main sort of ERP, the Oracle system that sort of does the sort of the payments and the receipts of income. So for the pension fund, although it does have an impact, obviously it doesn't affect things like the valuation of the assets or the main material areas aren't covered. It was primarily around sort of some access access levels and sort of security privileges hadn't been kept up to date while they were going through sort of a system conversion project. So it's kind of one of those. It's kind of people got behind waiting for a go live to sort of happen, which then got delayed by a year. So it's kind of they didn't do everything they should have done. So the material impact on the fund is a lot lower, and it is left more to kind of the LCC side of things, was where the impact would be felt. In terms of the pension system, it doesn't go through the external audit. Well, actually, no, that's not true. So they will pick up the transactions through there, but it's mainly the administrative type transactions. And also we obviously get the assurance from Hymans in there when they look at data quality and things like that. But internal audit will have a look at areas like that. But it's like the external audit stuff's probably not as in depth on the pension system by its nature. So I'm floundering a bit. Ian, is Ian on the call? Ian may be able to sort of add a little bit on that in terms of what is or isn't done.
Yeah, sure. Can everybody hear me?
Yes.
Yeah. In terms of the pensions admin system, we do have internal audit review, but it's more around the processes, not the actual technology. But what we do is we do external tests using LCC colleagues and Hayward's, who are the system providers, doing security checks around people trying to break into the system, those sort of areas. And that's completed. And in fact, that was done fairly recently, actually. We had a fairly thorough and robust check of the systems and the security around them. And I'm pleased to say the county was happy with that outcome and approved that. So I hope that gives you a bit more assurance.
Thank you.
Okay. Are there any? I can't see anybody else flagging up to ask a question. So could I thank you very much then, Declan? If we move on to agenda item 8, the restriction of public sector exit payments. And I think, Ian, you're commenting on that.
Yes, thank you, Chair. This report, it covers 2 points really. It's to inform the committee of the fund's reply to the consultation, and it's also to request approval of a solution for dealing with the impact of these changes. Just briefly, I thought I'd really quickly just explain what the exit cap was designed to do. It was initially designed to stop large payouts for high earners in the public sector, and it takes account of the pension strain that is included. And the pension strain is a pension payment that an employer makes to the pension fund when a member leaves the scheme early on redundancy or efficiency grounds. And that's what it was designed to do, to kind of cover high earners, stopping them effectively receiving large payouts. And this report basically now provides how the situation currently stands. So on the 7th of September, government proposed a consultation and published that regarding reforming the exit cap. And that followed several consultations going back over 4 years. And then on the 30th of September this year, House of Commons approved the exit cap change, and that was then subsequently signed by government officials and became law on the 4th of November this year. Now, the problem we currently have, which is slightly tricky for both certain fund employers, I should stress, not all fund employers are covered by the exit cap, but most of the larger employers are, like the councils, the city, the county, the boroughs, the districts. But then there are employers that aren't covered by it, like, for example, the universities and the admission bodies. But effectively, the law change that leaves us, those groups that are affected, in a rather tricky position, because the exit cap regulations and the local government pension regulations don't currently align, which is causing some issues. Hence, this report is requesting a proposed way forward on how we deal with these cases. So the impact on scheme members, well, currently under the LGPS regulations, if somebody is made redundant or retires on efficiency grounds, age 55 or over, they're entitled to immediate payment of unreduced pension benefits, and that's the key. It's the unreduced pension. But this regulation that's now come in has effectively changed that, because if somebody breaches the 95,000 cap, that effectively means the member isn't then able to go with the previously unreduced pension benefits, and this is where the regulations no longer align, and it's expected the LGPS regulations will be amended in the new year to resolve this. So what is proposed is, for cases that breach the 95,000 cap, the pension fund will offer one of two things: either fully reduced pension benefits or a preserved pension, which effectively means the pension doesn't go into payment, it remains in the fund, and then the member can choose to take that whenever they so choose from age 55 onwards. It is anticipated this is going to generate appeals, and this is a national issue. This isn't just our fund, I must stress that. And the Ombudsman is very well aware of this, and apparently is expected a case will be fast-tracked to the Ombudsman, because all funds are fully aware this is a difficult position. But this is seen to be the lowest risk approach, and that has been agreed by a number of parties, including external lawyers. For cases that do not breach the 95,000 cap, we're proposing to continue as we are now, which will be to continue to pay fully unreduced pension benefits on the basis that the employer and the employee have entered into an agreement to terminate before the LGPS regulations come into force. We anticipate that the change in the regulations will have a 6 months protection window. And unfortunately, we don't know when that window will start, because we don't know when the regulations will change from. So I've anticipated it will change from the beginning of the year, 1st of January 2021. So 6 months protection will allow us to continue with cases up to the 30th of June 2021. But that could be a little bit later. It could be further back, depending on when those regulations change. For cases that do not breach the 95k cap, that are outside of the protection period, what is proposed in the change is the member's pension strain will be reduced by the redundancy payment. So effectively, that will mean even people who do not breach the 95k cap will then have an element of their previously unreduced pension reduced. There are factors provided by the Government Actuaries Department on the strain calculations regarding this, but the actual detail will obviously have to follow, and then funds will have to follow that. Once the LGPS regulations change, then obviously we will then follow the LGPS regulations once confirmed. So really, this is just a report to lay those 2 points out. The only other thing I would like to just mention is that this has been to the board, to the pensions board, so they have had sight of this, and they are in support, and they had also seen, they had sight of the fund's reply to the consultation in advance, and they were in support of that. And indeed, it has been also to the chair of committee as well, but that was purely a timings issue, because I had to send the reply, unfortunately, before this meeting. So I hope that's clear as to why I've had to take that route. I hope that's helpful, and of course, any questions.
Okay, thank you very much, Ian. I suppose a bit depends on what happens to the appeals that are going through the system. Okay, has anybody got a question for Ian on that? Nick, you have.
Yes, Ian, thanks for that. Understand the timing differences that you were under that issue. 2 points really. Does this mean that if somebody is under the £95,000 limit, that they would still have long-term an unreduced pension, or would there still be an element of reduced pension if somebody was under the 95,000? Just make it absolutely clear, in my view, is whether it's just.
Can I come back on that one, Nick? Because you're absolutely right to hit on this. I think this is the point where the original expectation of the exit cap was to only impact on those members with the sort of the high earners, dare I say, Nick. But the proposed solution will impact on much lower income people as well. So under the current proposal, Nick, with the 6-month protection, members under the 95,000 will still continue to have unreduced pension benefits. But once the regulations change and the protection window closes, so let's say from July, Nick, and I put a provisional date around July, because obviously, as I say, I don't know when the regs will change, but let's say for July, for the sake of this, then from that point onwards, members under the 95k cap will still be impacted, and those previously unreduced benefits will have an element of a reduction applied to them. So it will impact on members under the 95k cap as well as those over 95k cap, Nick.
Yeah, because that is the issue that concerns me. It's not the high earners at all. It's the care assistant who's made redundant at 57 who takes an enormous hit on their pension. And the other part to that is the actuarial reduction factors, which I do not believe are actuarially neutral. If you forward them back, just seen the earlier report saying that, you know, female employees are expected to live to be 90, yet the actuarial reduction factors don't apply to that, don't suggest that.
If I can come back on that point, Nick, another very, very good point you raise. This was highlighted and raised nationally by a number of funds, including ourselves, because you're absolutely right. The current pension strain factors are not designed for this issue. Let's be completely honest about that, Nick. And that's been highlighted nationally, and that's why Government Actuaries Department, GAD, are introducing new factors that are equal for both men and women. So same-sex factors will be applied that will be used across all funds, Nick, to produce that level playing field. Because currently, as you rightly say, there is a difference between those sets of factors currently, and equally factors across all funds are different because they are designed not for this purpose. So this is why we all need to change to new factors, Nick.
Has the government actually committed to changing those factors?
Yes. the factors will change as part of this exercise, Nick. Yes.
Okay then, Nick.
Yeah.
Okay. Tom, did you have a question?
Yes, please. Yes.
Far away, Tom.
I think you're on mute, Mr. Barclay.
Yeah. Right. Can you hear me now?
Yes, thank you.
All right. So, taking Mr. Booth's point, an employee, say, who is 57 who retires has 8 years of non-contributions to the scheme, and therefore will suffer an actuarial reduction in another 6 months' time. They will have redundancy payment. Can they use that redundancy payment to actually increase their pension fund?
There are proposals in the consultation that would allow certain people to make payment into the fund to offset some of those reductions that could be applied.
Yeah.
How that will actually play out in the regulations once they're finalised, and how that will be then communicated is still for debate, Mr. Barclay. But potentially there is scope within the proposed regulations. I have to be careful on this, what I say, because until the regs are actually finalised, it's a difficult one for me to answer. But yes, there is proposal for a member to be able to pay a value. What that value is and how that's established is yet to be completely finalised, and whether that payment goes to the employer or the fund is also an issue that needs to be considered, I think. But yes is the answer. There may well be an opportunity for members to make a payment to offset some of the reduction.
Yeah, I mean, because there is a cost. I mean, as I understand it, if somebody does that and they retire early, the employer has to make a significant contribution to the pension fund to bring it back to where they would have been if somebody retires at 57. At the moment, they have to make a significant contribution to the pension fund, do they?
Yes, they do. That indeed is the pension strain cost that's included in the 95k cap. So you're absolutely right. It could be that a person who isn't necessarily a very, very high earner, but may have a lot of service, let's say 56, 57, the example you use, could have quite a potentially high strain cost. So could not necessarily will breach the 95k cap, but could be quite a significant strain, as you correctly say. So yes.
Yeah, and that impacts. Well, I suppose that doesn't impact on the pension fund as such, but I mean, the tax liability of somebody who's retiring with a huge redundancy payment, presumably they can reduce their taxation by actually making a contribution and reducing the employer's contribution.
Well, I couldn't possibly comment on the taxation side, other than to say the types of questions you're asking are the sorts of questions that I expect we will be getting lots of from scheme members in these situations. And it puts us in a slightly difficult position, if I may just touch on this, because the fund cannot give financial advice. But we're already starting to experience questions of this nature in terms of how much should I pay in? What can I get in terms of tax relief by taking these various options? What's the most tax efficient route for me to progress this? So it's already starting to generate a number of quite considerable issues for funds, and we're not alone in this. So I completely accept your point, but I think we have to be very careful in terms of how we answer that and how this is actually finalised in terms of, one, the legislation, and two, how we actually progress it from an administrative side.
Yeah, no, I fully appreciate what you're saying, and thank you for your answer. I mean, this is something which will have a huge effect on somebody who's, say, retiring at 57 for the rest of their life. So inevitably you're going to get a lot of questions, but I'll thank you for your answer. Thank you.
Thank you.
Nick, have you got a further question then?
Yes, thanks. Yes, as a 57-year-old with long service in the council, I was interested in that question, Mr. Barclay. Does that affect the rule of 85 protections that people still have, or is that still hard baked? In other words, because you've already achieved that. And then the second part of my question. Sorry, Ian.
No, that's a very good question, Nick. And I honestly, these are the types of questions, Nick. I knew you were going to ask me something of that nature. I honestly don't know, Nick, until this is finalised and the legislation is confirmed. But these are the types of questions we are getting, Nick. I couldn't comment to that level of detail, Nick, I'm afraid, at this point. But these are indeed good questions, Nick, because protections are inbuilt for the rule of 85 and how that impacts, and various and other questions around this. I do think we need a bit more clarity around the final regulation position, Nick.
Yeah, no, I understand, because this is going to cause an enormous amount of problems for authorities who are going through sort of savings exercises for people who think, well, actually, I'm not that fussed about if I'm made redundant, I'm okay, I'll go voluntarily. They will suddenly say, well, actually, no, I can't afford to go. And it will make savings exercises harder.
We're already experiencing that, Nick. I've had this conversation already with a number of employers who have already started to revisit exit plans at certain employers who have had to reconsider their stances and routes on some of these. So yes, is the answer, Nick. Yes, it already is. And
the other part, which would take, I know you're going to get a huge amount of extra admin work, but for individuals planning, like flexible retirement, it would be helpful for people to be able to sort of, not only, as Mr. Barclay suggested, use some of the redundancy to offset some of these pension costs, but also perhaps to split their pensions, so to take some of it and leave the rest as deferred.
I kind of almost expected you to ask that as well, Nick. Indeed, another very good question. And again, indeed, another area of legislation that needs to be completed and finalised around this, Nick. And you're not the only person to have already raised that either.
Okay.
I do apologise. I can't give you all the answers on this. It's extremely complex and challenging. And a lot of funds are already really challenged by this, as are indeed the employers.
No, I understand the difficulties. It just suggests that the government hasn't fully thought it through yet.
I'll withdraw comment on that, but I think further consideration is definitely necessary.
Okay.
Thanks, Nick.
Okay.
Right. If there are no other questions, you are being asked to note the fund's reply to the consultation on the restriction of public sector exit payments and to approve the fund's proposal for dealing with impacted cases from the 4th of November of this year. Are those recommendations acceptable to members?
Yes.
Yes, Chair.
Yeah.
Yes, Chair.
Thank you very much.
Thank you.
Thanks, Ian. I forgot on the previous one on the accounts. I should have asked the committee to approve the pension fund annual report and accounts for 2019 and 2020. So could I go back to that and just ask, will you accept and approve the recommendation to approve the pension fund annual reports and accounts, which you discussed previously?
Yes, Chair.
Yes, Chairman.
Approved. Yeah,
Okay.
approved.
Okay. Thank you. My apologies for not going on to onto that. We're going then on to the action. I think it's Declan who's doing the agenda item 10, the action agreed by the investment subcommittee.
Yeah, it's me, Chair. So the report's just for noting really about what the activities that took place at the October meeting. So it was 2 investments and 2 transitions that the committee were updated on. So the investments, they're both outside the pool, which obviously we try and avoid doing. It was a small amount to infrastructure and a small amount to private equity. And the problem with both of these is they do kind of repay money back to us on a sort of a fairly routine basis. So we do need to kind of keep putting money back into them to kind of keep our asset allocation in line. And Central don't have products available at this moment in time. So we did just make, like I say, a small allocation just to keep up to date. And it's with existing managers, so it doesn't add any kind of complexity to the fund. The other piece, a couple of updates that the committee received were around 2 transitions that are taking place with Central at the moment. First one, the Climate Factor Fund. It's another passive fund, but it tilts towards companies that have kind of got positive kind of climate attributes, and it's going to be around about the sort of £700 million mark. So it's probably going to be the biggest transition that we're going to do to Central in terms of one go. So and that's on track to go ahead in December. We've had all the permissions through for that. Emerging market debt is kind of the other end of the scale. It's only £100 million, so one of the smaller ones that we'll do. And this is moving from Ashmore to a couple of managers with Central, and they're going to do a similar thing to what Ashmore does. It's pretty much like for like. And again, this transition's on track to go in December. And that's the climate one. I should mention we're just doing that independently. It's an already established fund, and the Ashmore one we're doing with 2 other funds in the Central pool. So happy to take any questions.
Okay, are there any questions to Declan? No? Okay. If I'm right, then on the action agreed by the investment subcommittee, that the recommendation is that the committee are asked to note the content of the report.
Noted, Chair.
Okay. Thank you
Chair,
very much. If we then go on to the it's 143. Within that report, you've got a report that Declan just mentioned on the Adam Street Partners and private equity and the JP Morgan one. And I thought I noted right at the end, the recommendation is that the investment subcommittee is recommended to consider investment into Adam Street Partners 2020 Global Fund and JP 11 Fund. Is that recommendation?
Sorry, Chair. That's just because it's an appendix.
Yeah, I appreciate it. Okay. I was just making sure I didn't miss out the recommendations, etc., that you're formally meant to do. Right. I'll trash that then. Right. If we could move on then to the summary valuation of pension fund investments, and that's yours, Bulesh. Page 149 to 184 on your agendas.
Thank you, Chair. Can everybody hear me okay?
Yep.
I'll take that as yes. Okay. So it's a fairly standard report now. I think we've been running this kind of format for a while now. So we start off on page 149. We've got this table here that Central provide for us, and it's their tactical asset allocation view. We've been running this table in this format for probably 3 or 4 quarters now, and it shows down the left-hand side the broad asset classes. So we've got growth, income, stabilizing, investment styles and currencies, and where they feel we should be overweight or underweight. And what I'd like to do this period is kind of draw out the changes from last period. So there's 3 main changes that Central summarised, and the first one in their view is to increase the allocation to income assets, to overweight, mainly in infrastructure and EM debt, because that's where they feel the value is. And the second one is keeping growth assets underweight, mainly due to their high valuations. You'll probably be familiar with tech stocks, etc., being at sky high valuations, not seen since possibly the dot-com boom. And the third part there is stabilizing assets, and they think we should keep them underweight. Again, high valuations. Point 4 on that paper, still on page 149. It's worth noting that significant underweight and significant overweight positions have remained largely similar since last quarter. The only significant move being value investment style moving from underweight to overweight. So they felt as if the growth part had become hugely overvalued, and they thought maybe it's time to start investing within value again. The kind of things that I held within the FTSE 100, for example. And since quarter end, remember this report is to the 30th of September, we did have a little rotation into value. Value did outperform for a period of time. You'll note the FTSE 100 is well back over 6,000 again, and had been as low as 5.8, 5.7 at some points. So we've had a little rotation back. Just moving on to page 150. Again, this table you see here is a standard quarterly table that Central produces part of that tactical asset allocation, and it's worth noting there that you've got a number of asset classes there listed down the left that show huge negative returns over the 1 year period. Obviously, that includes a huge drawdown in February-March time when the coronavirus had hit. Interestingly, you have got a number there. The bottom three, for example, UK gilts, UK index linked, and gold, all performing relatively well over 1 year. And you can scroll over to the right there of that table. We've got 20-year comparisons where you've got three classes showing double-digit returns. So property, high yield, and gold. So these are classes that have shown double-digit returns on average over 20 years. It's quite fascinating to notice. But you'll also notice global equities sitting at just 5%, and that's largely a quirk of including the period, we're looking at the period from September 2000 to September 2020. And you'll note that if you can cast your minds that far back, the dot-com boom was around that time. So we're including a very high period back in September 20, and that will probably reset itself over time. So, the global equities 20-year number will start to increase. Going on to our fund's performance. So this is section points 6, 7, 8, and 9. We've had a performance of a plus 1.8 in the quarter to 30th of September, minus 1.1 over the last 12 months, and 3.9 annualized over the 3-year period. Casting your minds back again, we finished the last triennial on the 31st of March 2019, where we had assets circa 4.3 billion. We're at circa 4.6 now. So that's 0.3 billion in the year and a bit since. I'm just turning over the page to 151. We've got a little table there at the top, which shows our current weighting for equities, real income, alternatives, and cash. We compare that to the 2019 benchmark, and what I mean by that is the benchmark that we had approved for last year, and then we've got the 2020 benchmark, which is the benchmark we're moving towards as a result of the approvals we had at the January 20 meeting. And the last column on there shows our difference to that target benchmark. So we've got a plus 3.5 to equities, we've got a negative to real income, a negative to alternatives, and a positive to cash. Point 12 on the same page highlights that although we're away from the benchmarks, we're not overly concerned at the minute. The markets are quite volatile, and we're waiting for the markets kind of settle down. We've got some valuations which lag, i.e. we don't get up-to-date valuations every time. So private equity being an example, that the valuations aren't updated in the same way as, say, LGIM update their valuations every day. So as soon as they settle down, we'll have an opportunity to rebalance. We're also mindful of the fact that Hyman's are currently working on next year's strategic asset allocation for us. So we should have that in the next month or so. And it would make good sense then to rebalance at the same time, knowing what their new target allocations are, and hopefully markets will have settled down a little. Point 13, why we're slightly over on cash. We do hold a fair slug of cash at the minute. It's, at that quarter end, we had 133 million in cash, and 50 million was held with our currency managers. Given the volatility that's in the market at the minute, we're relatively comfortable with that, and holding a bit of extra collateral in cash, is useful in the event that, the currency markets move the wrong way and we need to provide additional collateral to Aegon, for example. Number 14 is talking about the fact that we will always have a bit of cash, and we're trying to get it away. Declan mentioned earlier the 2 investments we committed to last quarter, but admittedly, they won't get the money away straight away. We are waiting for the managers to call those. We have had an instruction with our direct property manager where we are underweight property to find suitable property. That's been ongoing since the start of 2020, and since writing this report, we have completed on one warehouse in Northampton. It takes another 10 million offers. I'm just going to flick over to 152. Point number 17, talking about our LGIM passives. Declan mentioned earlier, we are moving a fair portion of that to the Central Multi-Factor Climate Fund. And we are, again, mindful of rebalancing, and we have put to Hyman's how we kind of make easier our LGIM portfolio. We don't see it usually on our portfolio evaluation spreadsheet, but we hold a fair portion of geographical passive funds, and we're talking to Hyman's, we're wondering whether or not we can simplify those slightly, by maybe removing some of the geographics and moving into all world, etc. But I'm hoping Hyman's will come back with a valid proposal for us in January. Number 19 is the fund's performance over 3 years, 1 year, and 3 months, and we've got a bit of detail in the rest of that page. So pages, points 20, 21, 22, and 23. I'm just gonna pick up on a couple of points on 22 and 23, which talk about the real income. It underperformed the benchmark in the quarter mainly due to the infrastructure element, which was under benchmark. The other 2 elements were roughly in line. The benchmark for infrastructure holdings is LIBOR, which is pretty much 0. So really the target is 4%. We are holding some stocks in there which that are GDP sensitive and therefore will be revalued accordingly. So we've got 3 investments with KKR. I'm just going to pick up on KKR. We have one investment with KKR, one of our infrastructure funds. There's three separate investments within that. 2 of them are returning, but the last one is still investing. They're showing decent returns, the original 2, 15.6 and 16.4. But I just want to make a note that there is we have a little anomaly on the PE report, which we are discussing with KKR, and just trying to work out with KKR and portfolio evaluation the right numbers. So we'll hopefully get that sorted out for the next quarter. Flicking over to 153, a little section on LGIM there on points 26 and 27. We hold a couple of RAFI funds, so the developed Europe RAFI and North American RAFI, which have both performed poorly in the quarter to September. They hold those value investment stocks, which Declan's talked about previously, that they haven't performed very well in comparison to the growth areas of the market. Interestingly, since that September end, we had that little rotation where they did have a great pickup, but those are the 2 funds that we're completely divesting when we're moving towards the central pool, the 700 million that we talked about earlier. Within those LGIM passives also, we've got a UK holding, that was the worst performing geography within those passives, with a 2.4% loss in the quarter and a 14% loss over the last 12 months. The best performing was probably not unexpected. It was the North American fund, which posted 4.5 in the quarter and was on the back of a 22% return the previous quarter. But you'll probably be aware that the North American fund is hugely tech heavy, where a lot of the tech stocks are, and that's why we've benefited there. The next couple of sections talk about our two holdings with Central. So we have a global active equity fund with them, a multi-manager fund, and we also have an emerging markets equity fund, again, another multi-manager fund. Nothing blowout there to report, really. It is that the first one, the global equity fund, is still behind target by 3.05%, largely because one of the managers has a huge value bias, and that's the one that's been dragging us down. We wouldn't expect all three to be outperforming at any given time, because the whole point of having three managers is the diversification. And so Schroders and Union have outperformed the benchmark. Harris has underperformed, given it was chosen to be a value manager. Page 154 talks about the emerging markets equity fund. So since inception, given that we invested in this one early part of 2019, it's delivered 1.06 to date versus a benchmark of 1.07. So roughly in line with the benchmark, but our targets are a lot higher. So we want to outperform that benchmark, and the target is 3%. So it has underperformed to that. Again, we've got a manager that is underperforming, but the Central team do talk to each of the managers every month. They want to make sure they're sticking to their investment principles. Nothing's hugely changing, and they do report back to officers with a fact sheet every month and manager notes if needed. Just flicking over to 155, we've got a note here on EMD, so emerging market debt. So this is probably the last update we'll have for Ashmore. Declan mentioned we are transitioning away from Ashmore towards the Central offering, which is a multi-manager fund, or it's just two managers. So it's probably a good time to touch on the return we've had from Ashmore since 2011, which is when we first started this mandate. So we've had 6.08% since inception. That's over just over 9 years. The target, including the outperformance, is 7.13. So it's underperformed by 1.05, but it's largely on the benchmark. So you'll notice in that table on the last column there. So we've got since inception number of 608, a benchmark of 613, and then a target of 713. So we've had a number of conversations with Ashmore. We thank them, and we will be moving over to the Central multi-manager fund in early December. It's just worth noting, together with the climate transition we're working on, that just leaves one transition outstanding from the strategic asset allocation that Hyman's delivered in Jan 20, which is the MAC fund, which still isn't available at Central to transition into. Points 39, 40 and 41 talk about our property portfolio. I'm just going to move forward to point 41, which talks about Kames. So we have two funds with Kames. We have Active Value 1 and Active Value 2. Active Value 2, probably not worth talking about too much. It is performing quite well, mainly because of the types of assets it holds. Active Value 1, on the other hand, holds a number of assets which have been impacted quite adversely by the COVID situation. It holds retail stocks, it holds office stocks, and so they have suffered. We are keeping close with Kames, so officers do speak to Kames on a quarterly basis regarding their plans on how they're positioning it and the kind of issues they're having. Collecting rents from certain tenants can be quite difficult at times like this, where the legislation protects them quite well. So they're working through it, and we are keeping close with them, along with two other local authorities who are also investors in the fund. So Nottinghamshire and West Midlands are also investors in the same fund. So we speak to the managers together. I'm just going to fast forward to page 156 and target return. We talk about this one quite regularly, and we have three managers here, and the target is similar in the sense that it's LIBOR plus 4%, so effectively 4% now, given LIBOR's close to zero. We've, over the last 9 months this year, we've produced a flat return. which is, it's considerably less volatile than the equity markets, but nonetheless, it's short of the target. We'd expect to be, 3% by now, having been 9 months through the year. The 1 and the 3 year targets for target return are behind target, and the underperformance has been driven by Pictet and Aspect in the main. Ruffer has beaten the target in both the 1 and the 3 year timeframes, and they've kind of benefited from having this view of holding a lot of protection. So they hold inflation-linked bonds, they hold credit protection, they hold gold, which we saw on the table earlier has performed quite well this year and over various timeframes, and they hold gold equities as well, which are kind of a geared play on gold. So if gold moves by 1%, you'd expect gold equities to be at least double that in terms of movement. And the last section there on page 157 is a little look into a smaller holding we have, 60 million on the Distressed Opportunities Fund, DOF. We hold a number of investments with M&G, so we hold 3 funds with them, DOF 2, DOF 3 and DOF 4. 2 and 3 are paying back now, so they've got generally good returns, but number 4 is at minus 13% IRR, and that's as a result of having invested recently and still investing. So a lot of the investments that they're in at the minute have been marked down. We're hoping that if we come out of this crisis, things will be revised and marked back up accordingly, and they've still got money to deploy, so hopefully they can get in to some of these distressed opportunities, which is what it's been set up for, and buy debt and equity at distressed valuations, and hopefully we can ride it back up. I think that's the end. So thank you for sticking with me. Are there any questions?
Yeah, I can't see anybody indicating.
We've got Claire.
Claire, sorry.
Okay, no problem. Thank you, Chair. I guess just reflecting on sorry, I'm getting an awful echo on my. Anyway, I'll carry on. On my comments earlier on the governance review, there is a lot of detail in this paper. It really is really long, and arguably could spend a lot more time on it. But I'll pick up some high-level points I'd like to make, and maybe a couple of questions as well. On paragraph 9, page 150, talks about the size of the fund and the return assumed by the actuary. I'd maybe encourage when you think about the size of the fund, you consider the impact on the liabilities that the market's having as well. So it's not just necessarily the size of the fund that's important, it's actually what the liabilities and ultimately what the funding level has done. Also on paragraph 20, it talks around that the benchmark has assumed that the climate multi-factor fund has been already invested, and when comparing the performance of the fund with the benchmark, because you've not actually invested yet, the underperformance over the quarter looks to be quite significantly hit by 0.4 negative, because that's not happened yet. Maybe looks worse than it might have done, and maybe encourage in future not to change the benchmark until you actually have made the investment change. And then just a point of detail, and to maybe alleviate any concerns, on page 163, it's in the portfolio evaluation report. So just looking at, say, the legal and general performance, you'd expect the legal and general performance for each of the underlying sub funds to be, virtually the same as the benchmark. And you can see on the UK equity, you're actually outperforming. Now, maybe that's perhaps good, but for a passive fund, you should be concerned about outperforming. But actually, in practice, if you actually drill down to what's going on in the L&G funds, later with one of the appendices in the private papers, you can actually see the underlying funds are performing as they should do, virtually tracking their benchmark very, very closely. So there's something not quite right with the benchmark, I think, in terms of those funds, but maybe that probably plays into what Bilush said about trying to simplify what's going on in that legal and general portfolio. But there's lots we could potentially talk about investment, but in the interest of time, I would leave it at that. Thank you.
Could I just add to that? I think you're right there, Claire. So thank you for spotting that. I think the outperformance of the UK equity fund is a combination of a couple of things. We've got two separate funds there, an equity fund and a capped fund. And I think that the outperformance is as a result of having a fund, a capped fund, some individual holdings, and using a simple benchmark like the L-share index. So I can go back to LGIM and clarify that, but I suspect that's why it's showing a outperformance there.
Okay. There's a question. Is it from Marlies?
Yes. If I could, it was purely on the cash situation. We've got 133 million, which I take is probably the right amount of cash to have. I'm just wondering whether you are concerned when we get negative interest rates. I don't know where that 133 million is sitting at the moment. But it's being eroded by inflation, and I just wondered if negative interest rates do come for large amounts, whether that will actually hit us.
That's a very good question. I think, yes, we are earning positive at the moment, but you're right, it can be eroded by inflation. So ideally, we'd want to get down to as low as possible. We do have the MAC fund coming up next year, which will eat up some of that money. Likewise, we've committed to the smaller investments already with infrastructure and PE at the investment subcommittee. And once we've got Hyman's response to the 2021 target weights, we're hoping to do a little rebalance so we can get closer to all of the weights, and we'll come down to a cash level which we feel is appropriate given the volatility in the market. So you're right, Melissa, we will try and come a lot closer and reduce the cash balance.
Thank you very much. Thank you.
Anybody else? No. You're being asked to note the report.
Yes.
Okay. So thank you very much indeed. We're moving on to the risk management and internal controls on your agenda item 12, pages 185 to 200. And I think if he's back, that's Chris who introduces that.
Yeah, I'm here. I'm here, Peter.
Okay.
Yeah, I'm going to be very, very brief because I'm conscious we've got two external presentations kind of coming up. So the changes to the risk register are in paragraph 4. The only one I was going to really pull out is this kind of transfers out risk. This stems from, I think it was the George Osborne budget, probably about, I don't know, 5 or 10 years ago, where he allowed the flexibility for people to transfer their funds out of pension schemes. And we are getting an uptick in that kind of activity. So we've put it on the risk register. We do have controls in place. So, for example, if people are asking for transfers out, we do have forms that kind of try and signal some of the signs where this might be a bit of a scam. So you know whether it arises from a cold call or something like that. So we do put those on the forms, and any of the larger transfers out, so anything over 100,000, we do put through legal. And clearly we follow the pension regulator guidance as well. So just say it's on the risk register, but we have compensating controls, but there is an uptick in activity at the moment. I think the rest of it is kind of some very minor changes.
Any questions too, Chris, on the minor changes? No? Okay. You recommended that the committee approves the risk register of the pension fund. Is that agreed?
Approved.
Agreed.
Okay, thank you very much. We'll move on then to the responsible investing update. Is that yours again, Chris?
No, I've got that one, Chair Bullosh.
Okay, Bullosh.
Okay, so we've got 3 items here, that 2 standing items, one slightly new. So we've got our standard responsible investment update, and we've got our quarterly voting report and stewardship report, which we also include. And then we've got a little update regarding membership benefits of the LAPF, which is the Local Authority Pension Fund Forum. So the first part here is our quarterly voting report. It's included as Appendix A to this report, and it covers the period July to September, circa 44% of our assets. So that's all our LGIM passives, all our central active funds, which is the Global Emerging Markets Fund and the Global Active Equity Fund. Doesn't exclude the things that we can't vote on, obviously, but we are trying to expand the number that we're reporting on in terms of voting rights. Switching over to page 202, points 9 and 10 talk about how many voting recommendations were made at various meetings. So 864 meetings, nearly 9,000 resolutions in that quarter, and at 480 of those 864 meetings, the managers recommended opposing one or more resolutions. So that's 5,600 separate resolutions which have been voted against management or abstained at. And just like previous quarters, the majority of these abstains or voting against were based on board structure, and so that's 44% of those, and remuneration 14%. There is a breakdown in the appendix, and along with geographical breakdowns, etc. What we have had for the first time here is an update and it's shown in Appendix C, which is from Pictet. Pictet is one of our targeted return managers, and we've got about circa 170 million invested with them, and we have had an RI report from them for the first time. Point 14 shows that they've got a favourable performance versus the relevant benchmarks, against 2 carbon footprint measures, which is direct greenhouse gas emissions and potential emissions from their fossil fuel reserves. We then move on to the quarterly stewardship report, which we have provided a link. If you don't fancy reading PDFs, you can take that link and go straight over to Central's website, where all the previous ones are hosted as well. Switching to 203, we've got our responsible investing plan, and I think the best place to talk about that is the table on 204. We're hurriedly getting to the bottom of that list. We are coming to the end of 2020 now. What we have got this period now is the climate risk report, which we were planning to have now, and that's what we have Central on the call for within the private section. So we will run through that climate risk report in more detail then, and hopefully get some questions and some engagement talking around that. What we're hoping to do is digest it, take away your comments, and then produce a TCFD report, which is the Task Force on Climate Related Financial Disclosures, together with Central, and then hopefully put together a 2021 RI plan, which we will bring back to committee in the early part of 2021 for comment and approval. The last part here is the Local Authority Pension Fund Forum. We pay, I believe, £10,000 a year. The forum has 80 LGPS funds as members, and most of the pools too. We get a whole host of benefits, which I won't read through, but they are listed in points 25 and 26 on pages 204 and 205. We propose we continue membership for 10k on the basis that it provides a very wide range of benefits and support with FOI requests, etc. And we are able to demonstrate the firm's engagement on ESG issues as being a member as well. I think that brings us to the end of that report.
Okay, thanks. Anybody got any questions on that report before you're being asked to note the report? No?
No. Noted. Yep.
Okay.
Noted, Mr. Chairman.
Okay, thank you very much then. So that brings us on to the date of the next meeting, which will be the annual strategy meeting on the 22nd of January. That's always an important one because you're looking at the strategy for the future. But if you could also put in your diaries that there is the annual AGM that will take place on the 14th of December. Okay, if you could do those 2 dates, Now, before we move on to the exclusion of the press and the public, well, I might as well say this because then it can be turned off. The public are likely to be excluded during the consideration of the remaining items in accordance with section 100A and 4 of the Local Government Act 1972. So, Kat, can you turn off the public part of it, please?
Yeah, just bear with me while I get a confirmation that it's